It's Jobs Friday. Poll forecasters expect the economy added an additional 440,000 non-farm jobs in November, down from the 638,000 added in October. The unemployment rate is expected to fall to 6.7% from 6.9%. Our next guest expects the jobs numbers to come in lower than that consensus number. Michelle Girard says she expects an increase of 375,000 in total non-farm payrolls. Michelle is a co-head of global economics at NatWest Markets. Michelle, good morning to you. What accounts for that gap between you and consensus?
Well, again, when we're talking about the kinds of numbers that we have been looking at, job gains in the millions in some cases or losses, the discrepancies are hard to I think, over highlight. But, one of the things that has held our number down is there's two factors. The headline number, which I'm sure everybody is taking into account, will be, reduced by the continuing roll-off of census workers at the federal government level. And then even at the state and local level, we know that municipalities are obviously struggling with the COVID pandemic and have had to shed workers, and that continues to be a factor that weighs on state unemployment, but or employment levels. But the other factor that I think we're going to have to keep in mind, not only with payrolls, but with a lot of data that we see over the coming weeks for November and December, is we're just likely to get less seasonal activity than we usually do. And so when the numbers that are expecting an uplift, whether it's hiring for the holidays or more individuals out spending money at restaurants over the holiday season, none of that happens as much this year because of the crisis. And when the data, do the normal seasonal, they expect this uptake, they don't get it. It could actually put further downward pressure on numbers, make things look worse than the other actually may be. So that for us is a factor. Less retail and service sector hiring, exacerbated by seasonals that we're just expecting, more of the uptick like you usually see at this time of year.
We have that, and then also the impact of the lockdowns, which are only, it's only going to be the first 2 weeks of November in this jobs report. So, Michelle, could this be the last quote unquote good jobs report that we have in a while, because the impact of the lockdowns will really be felt in the December and the January numbers?
Yeah, Melissa, I think you're exactly right. To some extent, with these numbers, markets will take them with a grain of salt. Good, in the sense that it may be, if the numbers surprise to the upside, it may be that the markets feel it's old news. Because exactly as you said, the real bite from restrictions being reinstituted in many places is going to be reflected with weaker, December and January numbers. And so again, it does feel like some of this news is not as fresh as we would need it to be. And the other thing, though, to keep in mind is I do feel with the news, obviously the great news that we're hearing on the vaccine in general, the expectation is that it is, I think there's a wide expectation in the market. The numbers near term aren't going to look good. We know it's going to be a very difficult economic period again over the next couple of months, but we are looking forward. And honestly, while numbers for the near term have been revised down, we've taken our first quarter GDP number negative. We've raised our expectations for growth in the second half of 2021 and beyond. And so to some extent, the markets are even are able to look over this valley.
So it's a long, hard road for the economy between now and the back half of next year, Michelle. And I'm wondering if there's anything in this report that could lead the Fed at its next meeting in just a week plus time to change its tenor, to change, more importantly, the tone of its asset buying program, which a lot of people in the markets are watching very closely with the 10-year yield at 0.93% right now.
Right. Well, that is the point is, rather than actually reacting to the numbers, I think markets may worry about how policymakers will react to the numbers. I mean, it could be that if the numbers are better than expected, the markets worry, there'll be less pressure on Congress to pass additional fiscal stimulus. There'll be less pressure on the Fed to change their asset purchase program. And ironically, good numbers could undermine, some of the expectations that are being built in for more of a policy response. yes. We come down with next week's Fed meeting in not expecting the Fed to make changes to its asset purchase program. Actually, we expect kind of qualitative guidance. The Fed has been talking about giving us more of a sense of what would impact their decisions to probably ultimately reduce the asset purchases. But I will agree with you. It's a very close call even for us, and there are many in the markets that are expecting next week the Fed will announce that it will extend the duration of its purchases, meaning it will buy bonds that are further out the curve.
Right.
Shepard Smith here. Thanks for watching CNBC on YouTube.